I'm Nathan from Felina Management Consultants. The topic today is about preparation of a cash budget. What is a cash budget? It is an estimation of the cash flows of an entity over a specific period. It is used to assess whether the entity will have sufficient cash to finance its operations over the specific period. This period could be a week, a month, quarter, year, and so on. It is aimed at ensuring efficient allocation of cash resources. The sources of information for the cash budget would be either cash inflows or cash outflows. Cash inflows include but are not limited to sale of goods and or services, and under the sale of goods, we get cash recorded in the period of sale, and credit sales which are recorded when the cash will be received. In other words, if you sell an item today and you're expecting to receive money in the following month, the cash receivable is going to be recorded in the following month. Discounts allowable should reduce the sales figure based on the information provided. Bad debts written off should be deducted from the sales because the bad debts will not be received, and therefore they are not part of cash flows. Debt or equity. In this case, if the entity will receive or will need sufficient cash for its operation. Interest receivable, if there are any other investments where the business is receiving cash to finance its business. Cash outflows is recorded in the period of purchase. Credit purchases will be paid depending on the timing. Please remember to hit the subscribe button, give the lecture a like, and give your comments at the bottom. We can be able to provide you with more valuable information. Discounts receivable should reduce the purchase figure based on the information provided. Other sources of information for the cash budget will include debt payments, capital expenditure, long-term investments, other expenses like purchases, utility bills, rent, insurance, salaries, wages, and so on. Interest payable, dividend payments, and so on. Depreciation must not be included because it's a non-cash item. Please note that. The importance of the cash budget is mainly to ensure the sustainability of the entity by managing cash resources and appropriation efficiently. Let's look at one example of a cash budget. Nati Engineers manufactures bolts and it estimates $600,000 sales for the month of June, July, and August. At a retail price of $40 per box, the company estimates sales of 5,000 boxes or bolts each month. Nati forecasts that 80% of the cash from these sales will be collected in the month following the sale, and the other 20% will be collected 2 months after the sale. The beginning cash balance for the June is forecast to be $40,000. Nati also expects $200,000 in cash inflows from sales made earlier in the year to be received in June. On the expense side, Nati has to also calculate the cost of production required to manufacture the bolts that meet customer demand. The company expects 1,000 boxes of bolts to be in the beginning inventory, which means a minimum of 4,000 boxes must be produced in June. The production cost is $30 per box. All production costs are paid in the same month. The company also expects to pay $50,000 monthly on costs not directly related to production, such as insurance, office rent, and so on, in the same month. You need to go through steps of creating a cash budget as follows. Check if the entity will have opening cash balance. Establish reliable forecasts of the company's cash inflows. Establish reliable forecasts of the company's cash outflows. Obtain the closing balance for each month using the formula closing balance equals opening balance plus cash inflows minus cash outflows. Note that some of these flows will be predictable, such as rent and payroll costs. Others, like sales figures, will tend to be more variable. The closing cash balance at the end of the specified period will become opening balance at the beginning of the following period. The key to accurate cash budgets is to remember that receipts and payments are based on when they will occur. Below is the answer. The question says opening balance is 40,000. You need to calculate what cash is going to be received in June, in July, and August. And it goes as follows. In June, receivable 1 month later is 80% of 200,000 US dollars, which is giving us 160,000 receivable in July, nothing in June because it's a month later, and then the balance of 40,000 receivable in August. When you go to July, it's going to be received in August, and then the rest is going to be received in September. August figures are not going to be reflected at all because they always are expected in September and October. Now, when we add up our sales for each month, cash receivable for each month, June is going to be 0, July is going to be 160,000, and August is going to be 200,000. There's amount that is expected to be received in June because of the sales that took place in the previous month, and that amount is supposed to be 200,000. Now, when you add up, the sales revenue is going to be 200,000 plus 160,000 plus 200. The cash outflows are going to be calculated as follows. Let's look at the table for the cash outflows. Open units are already paid for, which are 1,000. Then it means that in the month of June, 4,000 will need to be purchased. And then July, 5,000. August, 5,000, as indicated in the question. Meaning, therefore, that the total units to be purchased, manufactured in June is going to be at $30 per unit. The same applies to July, which is 5,000 at $30 per unit. And lastly, August, which is also $30 per unit. So for June, 4,000, July, 5,000, August, 5,000. Multiply each by $30 per unit, you're going to get per box. You're going to get 120, 150, and 150 in the months of June, July, and August, respectively. These are going to be our cash outflows relating to the manufacture of the product for June, July, and August. So when you go back to our cash budget, you're going to see these amounts, cash, which is 120, 150, and 150, payments for production costs. And then non-production payment costs are going to be 50 of each month. And when we add them up, they give us 170, 200, and 200 as cash outflows. How do we get the closing balance? The formula for the closing balance is you get opening balance plus cash inflows minus cash outflows. And then when you look at opening balance here is 40,000, cash inflows 20,000, cash outflows 170, which gives us 70,000 as our closing balance. Then it becomes the opening balance in July. When we calculate July is going to give us 70,000 plus 160 minus 200, which gives us 30,000. Comes the opening balance for August plus 200 minus 200, it becomes 30,000. And therefore, our closing balance is 30,000. In conclusion, a cash budget is an estimate of the cash flows of an entity over a specific period. It's aimed at ensuring efficient allocation of cash resources. The key to accurate cash budgets is to remember that receipts and payments are based on when they will occur. Please remember to hit the subscribe button, give the lecture a like, and give your comments so that we can be able to provide you with more valuable information. The next topic about cash budget is going to be a bit more advanced. Thank you very much, and may God bless you.